Hello, bond investors. My name is Steve Shaw. I'm founder of Bondsavvy. I founded Bondsavvy in 2017 because very few investors take advantage of owning individual corporate bonds. They put money into stocks, they put money into bond funds, but individual corporate bonds offer higher returns than bond funds. They offer less risk than stocks. They provide income, opportunity for capital appreciation, safety, all these great things, but very few people know how to invest in them. And I want to change this. And a big part of changing this is educating investors on how corporate bonds work. And what we're going to talk about today is the flaws of corporate bond ratings. You all have heard of those, but we're going to explain what corporate bond ratings are, how they're calculated, and why they're all not particularly useful. Make sure if you get to this end of the video and you like it, be sure to subscribe to the Bondsavvy channel. We're going to be creating a lot more of these videos in the future, and make sure to give us a like. We would love that. So we're going to start off with what corporate bond ratings are, and then we're going to talk about how they're actually calculated, which is going to open up a lot of eyes because no one really knows how these things are calculated. But once you figure out how they're calculated, you're going to realize, well, why am I following these things in the first place? All right, so corporate bond ratings, think of it as it's an alphabet soup. And the main corporate bond rating agencies, there are two companies, Moody's and S&P. Moody's rates companies AAA all the way down to CAA3. S&P rates companies AAA down to CCC minus. You'll see that above this line includes bonds that are rated Baa3 and BBB minus. So anything above that is deemed an investment grade corporate bond. Investment grade corporate bonds examples of those would be Kroger would be a BBB. It would be a BBB bond. Apple, Microsoft, Johnson & Johnson. As of this video recording in the United States, there are only two AAA bonds, Johnson & Johnson and Microsoft. They're up here. Then below that is what's called high yield bonds. We also call them below investment grade. Some people call them junk bonds. They are not junk bonds, okay? The people who work at these companies, they do not work for junk companies, okay? Some of these companies are the best companies in the world. And it's just the way that bond rating agencies calculate the ratings oftentimes is why they're down here. Now, there are bad companies, and those companies deserve to be rated down here. But what I'm going to talk to you about is why there are companies that are often rated below investment grade that should really be investment grade. And that's where you can find really unique investment opportunities, because you'll find bonds down here that the herd, which is basically people who follow bond ratings, the herd will stay away from a lot of these bonds, but you can find some really good values. So that's the bond rating scale. But, and everyone's seen this. If you want, you can go. If you go to the Bondsavvy website, there's a blog post. Go to the Learn area, click FAQs, and then you'll see lots of different blog posts, including one about the bond rating scale. What's more interesting is how these bond ratings are actually calculated, because very few people know it, and once you know it, you're going to become very skeptical of bond ratings. So this is what are known as Moody's rating factors, and this is specifically for the soft beverage industry. So Moody's will have, and S&P will have different methodologies depending on the industry. And what they do is they weigh different factors, and that ultimately, in terms of how these companies perform across these different factors, that determines the rating. So Moody's, this is how it works. Revenue, so the size of the company, that is about 16% of the rating. Just the size. So it doesn't matter anything about the quality, profitability, anything like that. It's just how big it is. Then 40% is what I would refer to these fuzzy metrics, in large part. Product diversification, geographic characteristics, market position and brand strength, innovation, distribution, infrastructure, and pricing flexibility. So those all account for 8% each, so 8 times 5, 40% of the rating. So just these two items combined are 56% of the rating. And you look at these things, innovation, pricing flexibility, geographic characteristics, product diversification. I tell you what, a big company can go belly up just as easily as a small company. And I would even argue that a big company can be more difficult to manage. You've got stuff going all over the place. And just because a company is big doesn't mean that it has less default risk. But that's unfortunately how Moody's and S&P look at the world. You then get into some different factors which make sense. So next is financial policy. That's 16% of the rating. Financial policy would be things such as, okay, if the company earns $1 billion, what does it do with it? Is it buying back all sorts of stock, like unfortunately a lot of companies do? Is it paying dividends? Is it using it for CapEx? What is it doing? Is it using it for things that could improve the profitability of the company and as a result improve the lot for bondholders, or is it doing things to damage it? Margins, so that's 7%. We would argue that's an important thing. And lastly, this is another important one, leverage and coverage. So leverage ratio is just the company's total debt divided by its cash flow or its EBITDA. If it's say 5 times and higher, that's very risky. If it's 2.5, 3 times and lower, that's generally fairly safe territory. But that makes sense. So you've got 44% that gets calculated for metrics that actually make sense. But you've got this whole other thing over here that, let's say the company goes out and just does a huge acquisition, a big global acquisition, and the target isn't really that profitable, it doesn't really add much to the business. Just because it's getting bigger, it can influence the weighting. Whereas, let's say it's a company that's just in the US and has high margins, low leverage, high interest coverage. Oftentimes those companies can be single B or even double B just because they might only be in the United States and they're small. Those companies oftentimes there's a negative bias against those companies when it comes to bond ratings. And that's one of the reasons why I started the company, is because the bond ratings don't do anything to figure out whether a bond makes investing sense. That's what Bondsavvy focuses on. Now, other things in terms of what bond ratings don't do. So first of all, I would argue that they don't calculate credit risk particularly well. On the margin, it's okay. I mean, obviously, Microsoft isn't going to go bankrupt. Apple's not going to go bankrupt. But where there's a gray area, they do a very poor job in our estimation. And a few other things that they don't do. So a bond rating doesn't determine the value of a bond. If you think about it, we're trying to find, okay, if we buy a bond that's priced at 85 and has a yield to maturity of say 6.5%, is it a good buy? Is it a compelling relative value versus other bonds that are available in the marketplace? And bond ratings don't do that. Bond ratings do not consider interest rate risk. So they don't necessarily say, well, if you buy these bonds this bond that's due in 2040, that it's a high interest rate risk. It doesn't give you any color on that. And they hardly ever update. So if you're looking for, you could have a bond rating that stays the same for years and years, 5 years, 10 years. And so if you're looking for a bond rating as a signal to buy or sell, it's going to be crickets. And that's one of the reasons why Bondsavvy makes quarterly new recommendations. Then we update those recommendations every quarter, indicating whether there are buy, sells, or holds. It's the only way to decide whether it's time to buy a bond or not. You need to update it regularly. Now, what they do, and this is important, because since the herd, i.e. bond funds and ETFs and many investors, follow bond ratings, they do impact the market in 2 key ways. So first, they impact how bonds trade. What I mean by that is if you're on a trading desk and a bond is investment grade versus a bond that's high yield, those bonds are going to trade in different ways. They're quoted in different ways on a professional trading desk. And to make a long story short, if a bond is a high yield bond, that bond is generally not going to be as sensitive. It's generally not going to be very sensitive to changes in treasury yields. Whereas, say, a long-term investment grade corporate bond, as the treasury market moves up and down, that bond can be very sensitive to changes in treasury yields. And if you go to the Bondsavvy blog in our FAQ areas, there are lots of articles about that. Last point is that they will cause price movement. So let's say that a bond was rated investment grade and it gets downgraded to high yield. So remember, following bond ratings, that's the herd. And those are the largest bond funds in the world, and those bond funds often have rules that say, okay, we can only own bonds that have a rating of at least Baa3 by Moody's. And so what happens is that if that bond gets downgraded to say B1, then that fund has to automatically sell that bond. And oftentimes that the price of that bond can fall. Similarly, if it's let's say it's a high yield bond, let's say it was rated B1, all of a sudden it's been knocking the cover off the ball, it's having great operating performance, and it gets upgraded, then that price of the bond can go up. So while we do not believe in bond ratings, it is important to understand them, because when we do our analysis, we want to know, okay, at what point could a bond be upgraded or downgraded? Because if we recommend a new bond and it's right on the cusp of either being upgraded or downgraded, that can have a big impact in terms of the future price of the bond and the bond movements. So thanks so much for watching this video. Again, we're going to create all sorts of new videos about corporate bond investing. Again, please be sure to subscribe to the Bondsavvy channel, like this video, and of course check out the Bondsavvy website. Thanks so much.